All right. So we're gonna go through two more steps here, where we are and then where we might be headed. We've mentioned this. Scott mentioned this earlier. Inflation is increasing. Economic and earnings growth are accelerating. Monetary and fiscal policy remains very, very supportive. That's a rare combination, having all those things move together. And there's something that they say all the time in like industry meetings, and that's don't fight the Fed. And the Fed has been very clear that we are going to be very supportive. The new administration has been very clear. We're going to spend lots of money. All of that ends up really supportive of equity markets, even if rates go up a little bit. So that's all positive. And the reality is, so there's two lines here. The blue line is the size of the economy. That is the trillions of dollars of GDP that the US puts out. And the very far left of this chart is the year 2000. And it's not a straight line, but it's pretty darn close, with 2008 being a very minor blip. Once you look past it, if you look at this here, if everyone sees my arrow there, what's happening over the COVID thing out 10 years, it's going to look like this. It disappears over time. And the yellow line is the very extreme, the trailing 12 months. It's the recent year over year rate of growth in the GDP. So the economy is growing for sure. And the print that we're going to get, I think it's the 29th of this month, we'll get GDP for the second quarter. That's going to come in, somewhere 7-ish, 9-ish. It's going to be a record. It's going to be a very big print. And there's reason to think that slows from that number, but doesn't go to sub 2% anytime soon. At the same time, unemployment or employment is improving. And it has improved very quickly, and now it's improving slowly. And that isn't necessarily just because there aren't jobs. There are jobs, but there's a lot of information out there about, let's see here, let's go over here. A lot of reasons that it's, there's about, I think in June, there was a study done that said there's still 4 million people that want to go back to work. And we actually had a meeting with a client a couple of days ago who really wants to go back to work, got the job, went back to work, was terrified, and had to quit working again. There's an emotional challenge to get back to work and to be with people, and when things go on. And so there's going to be challenges with, there's a Delta variant, there's a Lambda variant, and there's going to be issues, not just, real fears, but there's going to be also psychological things that come out of this. There's some people that said the unemployment benefits were too generous, and so we've got about 50% of the states that are reducing those. They're not improving any faster, so that's probably not the reason. Interesting thing, for years we've been trying to increase the lower wages, and what we've discovered is when employers really need to hire somebody and they raise their wages, they can find people to hire. That's an interesting discovery that companies are discovering, right? A lot of parents can't go to work if kids don't go to school, and that's still an issue in some places. So, or if you are a caregiver for somebody, you can't go back to work. These are normal issues that have always existed. A lot of people, and we're actually experiencing some of this in the office. They're reconsidering their careers. Do I want to do this? Do I want to do something else? And if someone wants to do something else, now is a great time to do a career shift. A lot of folks are hiring, the opportunities exist, and so they're making those changes. And there's some other things as well that are changing the unemployment story. And we have all this pent up demand. Like, this was what we see in this orange yellow above the line here. This is all the non-consumption, right? This is all the savings that we did during the pandemic, whereas we didn't consume. This is the changes in the consumption and the changes in the savings rates. And the blue is the changing in consumption, and the orange is the change in the savings rate. And so what we've seen is, now that we can again, we are spending. Our consumption is going up, as a sort of, and our savings is going down. But we call this revenge spending, right? We haven't spent for so long, and now we're going to do these things that we wanted to do. And the thing Scott was referring to earlier is we still can't travel everywhere we want to travel. I have clients that love to travel, that tell us, they're still not comfortable going to places that they love to go to. And so they're not scheduling those things. I know my wife and I looked to doing some travel this summer. And we started a little bit too late. And so by the time we got around to reserving space, there was no space to reserve. There were no cars available. The lodge was full, the cars were gone. And we just said, forget it. We're going backpacking. It's interesting. There were lots of opportunities for backpacking, like the permits for backpacking in the King Canyon Wilderness, where there's many permits. So it's awesome. That's what we prefer to do anyways, get away from people. And then at the same time, supply chains, right? All of these things, labor issues, commodity prices. You might've seen that lumber went up 1,000%. The price of lumber for anyone trying to rebuild something went up 1,000%. And now it's come way back off. So it's already come back to earth a little bit. But the price of materials, you've probably heard about the chips, in cars or in computers or in cell phones. I have a 16-year-old son, he's not a clothes horse, but occasionally you got to buy a shirt for the kid. And we went online to try to buy shirts for the kid, and there weren't any. you couldn't get the $8 shirt or the $12 shirt. You could get the $80 shirt that was available. You could find that. But there were no reasonable price shirts anywhere, which is bizarre to me. But what this all leads to is it leads to this question. And this is really the big question. We have inflation. It's being called transitory. There's a problem with using the word transitory in, thinking about inflation, because inflation stacks. If we have 5% inflation now, that doesn't go away unless we have deflation later. So if we have 5% inflation and that becomes 2% inflation next year, we're building that 2% on top of a 5% that's permanent. So transitory is the wrong word to use, unless you're just talking about that number, 5%. It is, I think, a very fair thing to say that the 5% inflation that we're seeing will slowly decline to 3.5, and then 2.5, and then 2. And that's largely because there are 4 deflationary forces that are much bigger and much more powerful than the government spending $8 trillion. And those 4 forces are the broad availability of information, because of this, not even a new thing anymore, the internet. The fact that all this information is available out there in terms of, pricing products drives prices down. If I can go online and look at copper or lumber or shirts for my son or shoes or jeans or solar panels, and I can compare prices, that means prices have to go down. Everyone competes on price. Demographics. People are, and this is largely a millennial thing, they're spending money differently. They're more interested in doing good than they are in buying things. They're more interested in experiences than they are in stuff. That means the demographics will drive prices down. Globalization. That's, there is a question about how global we're going to be. That's one of the long-term issues we're going to have to face. But globalization is not going away. And then finally, technology. Technology is a deflationary force. And those 4 things are more powerful, I believe, than our enormous government spending programs. The government still has to spend wisely. Infrastructure makes sense. There's things that we should do. I hope that we see that. If we don't, that won't kill us. It'll be much better if we see it. We'll see growth return, and things will be better. So I think that transitory is the wrong word to describe inflation. I do think we're just seeing a blip, and that blip will calm down in the future. So I'm not worried about long-term 7.5% 1970s inflation. Not at all worried about that. That doesn't mean the fear isn't there. That doesn't mean the headline risk doesn't exist. So there is this concern that if the Fed sees inflation, and there are agitators, there are people out there that are saying to the Fed, you're wrong, you're wrong, you're wrong, you're wrong. If the Fed changes course and decides, you know what, maybe we should be careful and we should raise rates, and they do that too early, that'll reduce growth. If they taper their bond purchases, which really honestly they should do, right now they're spending $80 billion a month on mortgage securities to boost The housing market, really, the housing market doesn't need boosting right now. That is as strong and healthy as possible. So there is the fear that the Fed will raise rates is itself a market effect. If we are all afraid the Fed will raise rates, then we will all try to get ahead of that. And that definitely has an effect on valuations. So we're watching that very closely.